Hey everyone, welcome back to another edition of Super Prime UK with your Super Prime valuation specialist, myself, Rob Cohen.
And myself, James Wild.
Hope you're all well, hope you all had a good week. Loads to share with you this week. I've been travelling, lots happening back on the university scene for all those students out there. Really excited to be on that roadshow. And the market is busy, and James will be sharing with you the latest news and intel and data as we do every week. So straight over to you, James.
Thanks, Rob. So another positive week in terms of the London residential market. New instructions still suffering a little, Rob, in terms of low stock for estate agents. Similar numbers this week, 332, just 2 less than last week, so I think that's positive, with there being a slight uplift on some of the other weeks we've had. They've been sort of mid to late 200, so I think that's a positive. Slightly more stock coming onto the market. In terms of the sold figures for this week, we're at 139, so we really have been quite steady for this first quarter of the year 2022, which is positive. Like we said last week, Rob, we want that sort of slow, steady growth in terms of the market. We've obviously seen quite a big surge in prices in the last 18 to 24 months. So now I think a period of steady growth would be very good for not only the property market but the economy, that closing that sort of wage gap in terms of the inflation there versus the house price growth.
I think the market is crying out for consistent, sustainable conditions. And I feel that's exactly what we're seeing as we reach the end of the first quarter of 2022 and we head into quarter two, although we've come through a period of extreme uncertainty and we continue to be in uncertain times in a micro UK residential and commercial real estate market. We are reaching some consistency and very level transactional volumes and input, and I think that's positive.
Yeah, definitely. And just in terms of whilst we're talking about the transactions and being a little bit reflective, according to the Barclays FirstTime Buyer Index, first-time buyers actually doubled last year, which I think is a definite positive. More people getting on the property ladder, achieving that sort of goal of home ownership. However, the average property price of these the homes they're buying is down in the region of about £12,000. So obviously, slightly smaller houses possibly being built in terms of that new build stock, or maybe targeting more starter homes, which are that sort of slightly bit more affordable. Just in terms of some of the data that they've released, so most first-time buyers, they start to save. They're sort of able to afford to save at the age of about 24, and then the average age of acquiring a property for a first-time buyer at the moment is about the age of 32. So some of the data we've got recently has seen that actually that average age of the first-time buyer increase by up to a couple of years. But seeing the data with first-time buyers actually double, I think it's just the sheer volume of transactions that we saw in 2021, Rob, that's actually just manipulated that data a little bit, because ultimately I think it was a very positive year for those first-time buyers acquiring sort of homes, new homes, making use of the 95% mortgages, Help to Buy and all those incentive schemes.
Yeah, I think it's an area that we've touched on previously on the show. I think we raised when that data came to us how significant and important it was that first-time buyers were having a strong access to the market. And I think good news stories like that do get lost. I think we hear week on, week out how difficult it is to enter the market, which it is, and how unaffordable a lot of markets are, which they are. At the same time, when you have such a strong period where first-time buyers have had such great access due to some very good incentives and schemes brought forward by the government, I think we have a responsibility to relay that and share with everyone, yes, challenging conditions, prices difficult, affordability difficult, entrance first-time buyers always difficult. At the same time, very strong performance and let's hope that that number continues and it grows, and let's hope that the average age can come down to enable first-time buyers, younger ones, enter as soon as possible.
That's it. Thanks, Rob. Just in terms of, want to revert back to discuss the interest rates and the UK base rate, and just what impact that's had on the sort of mortgage market so far. So we had the second interest rate rise, obviously earlier this year, which saw 518 mortgage products removed in February 2022. So, a pretty significant drop-off in terms of the available products there. This follows a period of, Rob, as we discussed on the show, record low mortgage rates. The lowest we saw was 0.83 for borrowers in 2021. In terms of that fall off, in terms of mortgage products, it's the biggest fall we've seen since May 2020, and obviously the outbreak of coronavirus and the pandemic, which saw 626 products removed from the market, just in terms of the uncertainty of the property sector and where prices were going there. So I think that's an interesting one, and possibly it's going to follow suit in the months to come. I think lenders are going to have to be quite reactive in terms of the interest rate changes. Brings us on to the Monetary Policy Committee meeting later this week, Rob, to decide if interest rates will remain at their current level, whether they'll be rising to 0.5%. Any sort of view on that?
I think it's already built in that there are going to be further hikes, whether it's now or later. I think we're all pretty clear on that. I think what is interesting is the mortgage products, along with inflation and the new modelling behind affordability for those new products. That's the interesting space and piece that we need to monitor. And I think it's already having an impact. The combination of interest rates rising, the combination of affordability coming down because of living costs going up, and the mortgage products changing for those reasons, it's already impacting the market, and I think we're going to have to really pay a really close eye to that. It's going to have an effect. Yeah,
I definitely agree with that. In terms of the market, we've got interest rates rising, the cost of mortgages rising, inflation rising, the gap there in terms of the average wage to the price growth we've seen. There's a sort of widening gap there, and obviously the growth we've seen in the UK property market, I think, can only really taper off as people are sort of hit in their sort of disposable income and home expenditure. On the interest rates, Rob, I mean, many of the analysts are suggesting that by the end of the year we're going to be about 1.25% on the base rate. So this would be sort of three incremental rises, about 0.25%, to sort of take us to that level. So whether we see an interest rate rise this week at the start of what would be Q2, that would then spread quite evenly to the start of Q3 and Q4 and avoid a December interest rate rise like we saw last year, which politically was sort of one of the first ever we've seen in December and would be sort of quite unpopular with the general public generally. So we'll monitor that and bring you news next week of the outcome there.
Yep, looking forward to that, James.
Thanks. And just to finish a couple of points, we've got the residential property developer tax, bit of a mouthful. This is coming into effect from April 2022, so next month, and the policy has the objective of requiring residential property developers in the UK to pay an additional tax fund for remediating any of the cladding issues, which we've seen sort of cast a shadow over many of the high-rise blocks over the last few years. And the HM Treasury, who've been involved in terms of the policy and consultation on this, has been quite clear throughout that the process. It sees the RPDT, the Residential Property Developer Tax, it sees it as time limited in terms of its taxation use, with the goal of the taxation scheme being to raise £2 billion of revenue to put into that fund of remediating cladding, which they're sort of hoping will be over a period of around 10 years before that is sort of faded out. The tax is set to be set at 4% of profits, although there will be around a 25% million pound threshold for that, therefore capturing most of the sort of larger UK property developers and house builders. And you know, I think that's reflective of the market, as they have ultimately been building their sort of churn of stock which they've been developing has been sort of some of the main offenders in terms of blocks which have required sort of government investment in remedying some of that flammable cladding. So that's due to come in next month. And I don't know, Rob, do you think at this time when build costs are rising sharply, as well as other factors, could this potential cost increase, could it be passed on to consumers?
I mean, ultimately, margins are so thin for all of the reasons you've just brought forward. Someone is going to have to pay for it. It's clear that the government want it to be the developer. Ultimately, the end user is going to pay a price for that.
Yeah, thanks, Rob. And just to finish, sort of quite close to home, concept images have been released of the Euston's HS2 terminal, £500 million station, Rob, being constructed. It will comprise 10 platforms and is due for operation between 2029 and 2033. That's the sort of timescale of the delivery, and the current cost estimate of HS2 between 72 billion and 98 billion in terms of their cost estimates there for the sort of track and construction. A number of compulsory purchases of residential property, facilitation works have obviously been factored into that as well. Controversially, last year we had the Eastern branch into Leeds from the East Midlands hub was scrapped, which obviously disappointed a number of people in that region. Rob, as we've seen other areas of London be developed, mostly sort of King's Cross, are we going to see any sort of signature residential development and possibly towers around that area? Is it going to be a new sort of office hub, a new district?
I'm very close to home for us, and I've been following that location for a good decade now. I'm very confident that whatever comes there will be positive for the area, positive for regeneration. It's a natural extension to everything that's happened in King's Cross, and it will extend the northern hub of office space and the office market for sure. And I think it's going to be really positive for the area. I think only good things from that, and I very much hope it all happens and all comes through as quickly as possible.
I think the next 10-15 years are going to be particularly active there in terms of building construction.
Absolutely. Brilliant updates, James, as always. Thank you so much. Thank you to the audience and everyone listening, both on YouTube and the podcast, and great engagements on the socials. We will be with you again next week with all the updates, all of the intel, all of the property and finance as we see it each and every day and each and every week, live on the ground within the industry. Thank you all. Great input, great engagement, and we'll see you all next week. Thank you.
Thanks, Rob. Thanks very much, everyone.